Welcome back, investors, to Ticker Time News. I'm Adam, and although shares of ZipRecruiter, ticker symbol ZIP, remain down over 10% on the year, Zip's $50 million accelerated share repurchase program announced earlier this week has prompted me to take a second look at this employment marketplace company. One reason why the stock has been pushed down in 2022 is that it holds a somewhat pricey valuation at 27 times fiscal year 22 earnings. However, it is worth noting that Zip trades at a sizable discount relative to other job matchmakers like Upwork, ticker symbol UPWK, which is not expected to be profitable until fiscal year 23, and Fiverr, ticker symbol FVRR, at 98 times forward earnings. Also, Zip just went public through a direct listing in May of 2021 and is considered a growth stock. Investors are a bit lukewarm towards growth stocks right now as interest rates rise and uncertainty looms in Eastern Europe, especially towards those with relatively short histories as public companies. And knowing which stocks are beating the market so you can too by clicking the first link in the description. Now, Zip is a software as a service company, deriving its revenue from paid subscriptions by employers. Zip allows employers to post jobs to over 100 different job boards. When companies face staff shortages, particularly in retail and food services, Zip benefits as companies are motivated to utilize as many staffing sources options as possible, keep operating at high productivity levels and regular hours. This demand was quite visible in Zip's Q4 earnings report earlier this month. In Q4, revenues nearly doubled at 93% year over year to $220.1 million, easily exceeding Zip's forecast of $203 to $209 million. Now, quarter over quarter growth was just 3%, but Q4 is typically the slowest quarter since hiring decelerates during the holiday season. So that growth relative to Q3 is noteworthy. Perhaps more notable was the 64% year-over-year jump in Zip's paid employer count, all the way to 147,000. Revenues per paid employer also climbed, although not as quickly, at 17% year-over-year and 19% quarter-over-quarter to almost $1,500. As there were just 600,000 active labor force participants for every job opening in 2021, those astounding numbers may not be that surprising. However, it's worth pointing out that employers were proactively recruiting talent instead of just sitting back and waiting for applications, a key difference that is benefiting ZipRecruiter. Looking ahead, Zip is building in a gradual return to a more traditional macroeconomic pattern by year's end. Still, its guidance topped analyst expectations. For fiscal year 22, Zip guided to revenues of $878 to $892 million, or just under 20% year over year at the midpoint. That level of growth is a sharp drop off from the 77% in fiscal year 21, but it's still slightly higher than pre-COVID levels. A bigger standout is Zip's adjusted EBITDA guidance of $123 to $137 million, which translates to margins of 15% at the midpoint, well ahead of its pre-pandemic margins of just 2%. Despite its somewhat pricey valuation, Zip remains a solid play on a tight labor market. Although upcoming growth is not expected to be close to fiscal year 21 levels, the previous year set Zip up nicely to build on increased market share. Zip's margins are also healthy, and its $100 million share repurchase program announced during Q4, $50 million of which is for the accelerated share repurchase program, signals that management believes its stock is undervalued at current levels, and I'm inclined to believe so too. So what do you think about ZipRecruiter? Let me know in the comments below, as your comments make these videos so much better. Smash that like button, share this video, and click the first link in the description to beat the markets with us. And if it's your first time watching, click subscribe. For Ticker Time News, I'm Adam. Thank you so very much for watching, and I'll see you in the next video.